Ever wondered how cryptocurrencies work? Let's dive right in. Cryptocurrencies, in essence, are digital or virtual currencies that leverage cryptography for security. This isn't your typical dollar bill or euro coin. Cryptocurrencies exist in a realm far removed from government control and regulation. They operate on something called a blockchain, a decentralized distributed ledger technology that records every transaction. This ensures transparency and security. So, in a world where traditional currencies are constantly under the watchful eye of the government, cryptocurrencies provide an alternative, offering freedom and anonymity. But they're not just about financial transactions. Cryptocurrencies are changing the way we think about money itself, shifting power from institutions to individuals. They're not just digital money, they're a revolution. A revolution in how we transact, how we trust, and how we maintain control over our own assets. Cryptocurrencies are not just digital money, they represent a revolution in how we think about and use money. But what exactly is this blockchain that powers cryptocurrencies? Let's dive right in. Blockchain, as the name suggests, is a chain of blocks. But we're not talking about your childhood building blocks here. In the context of blockchain technology, a block is a bundle of digital information, and the chain is a public database where these blocks are stored. Each block contains a list of transactions. These could be you buying your first Bitcoin, sending some Ethereum to a friend, or even a company issuing shares digitally. Each of these actions forms a transaction, and every transaction made within a certain period gets bundled into a block. Now, where does the chain come in? Well, imagine a literal chain of blocks, linked to each other in a specific order. Each block in the blockchain is connected to the one before and after it, creating an unbroken and unalterable chain of data. This is where the beauty of blockchain lies. Once a block is added to the chain, it's extremely difficult to go back and alter the contents of the block. This is because each block contains not only the data of its transactions, but also a unique code called a hash, and the hash of the previous block in the chain. Change any data in a block and its hash will change, breaking the chain. This immutability of data is what gives blockchain its robust security. It's decentralized too. That means the information isn't stored in one place, but spread across many computers or nodes around the world. Every node has a complete copy of the blockchain, and they all work together to validate new transactions and record them on the blockchain. This decentralization means there's not a single point of failure, making the system highly resilient. So blockchain is a kind of digital ledger, a place where all transactions are recorded transparently. It's decentralized, secure, and unalterable. So blockchain is the backbone of cryptocurrencies, ensuring transparency and security. Now let's dive into the role of cryptography in cryptocurrencies. Cryptography is like the secret sauce that makes the whole crypto world possible. It's the complex mathematical algorithms that ensure transactions are secure and new units of currency can be created. In the realm of crypto, two key elements come into play: public keys and private keys. Picture your public key as your cryptocurrency mailbox. It's your address where you receive funds. On the other hand, your private key is like the key to that mailbox. It's kept secret, and it's what you use to access and manage your funds. So when you make a transaction, it's encrypted with the recipient's public key, and when they receive it, they decrypt it with their private key. It's this cryptographic dance that keeps transactions secure and ensures only the intended recipient can access the funds. Cryptography is what keeps your transactions secure and your cryptocurrency safe. You might have heard of mining and wallets in the context of cryptocurrencies. What are they? Well, let's break it down. Mining is a fundamental process. In the world of cryptocurrencies, it's like a giant worldwide competition where powerful computers race to solve complex mathematical problems. These problems are so intricate that they require significant computational resources to solve. But why all this computational hustle? Well, these problems are tied to the validation and addition of transactions to the blockchain. Miners who operate these powerful computers essentially work to verify the legitimacy of transactions, preventing fraud and double spending. Once they solve the problem, they add the group of transactions known as a block to the blockchain. This process ensures the integrity and immutability of the data on the blockchain. But there's something in it for the miners too. For their efforts, miners are rewarded with newly minted cryptocurrency coins and transaction fees. This process of mining not only secures the network, but also introduces new coins into the ecosystem. Now let's switch gears and talk about wallets. Just like you store your physical money in a wallet, cryptocurrencies also need a safe place for storage. That's where cryptocurrency wallets come in. They are digital tools that help you store, send, and receive your digital assets. There are two main types of wallets: hot wallets and cold wallets. Hot wallets are online and are often more convenient for frequent transactions. They are like the wallet you carry around in your pocket. On the other hand, cold wallets are offline and are akin to a safe in your house. They offer enhanced security for long-term storage, protecting your assets from potential online attacks. So in a nutshell, mining and wallets are two key components in the cryptocurrency world. Mining ensures the blockchain's smooth operation by validating and adding transactions, while wallets provide a secure home for your digital assets. So, mining keeps the blockchain running and wallets keep your cryptocurrencies safe. Cryptocurrencies are known for their volatility, but what about their legal status? When it comes to the world of cryptocurrencies, volatility is the name of the game. Cryptocurrencies are notorious for their price fluctuations, with values capable of soaring and plummeting dramatically over just a short period. This volatility can be attributed to a variety of factors, including market speculation, regulatory news, technological advancements, and macroeconomic trends. While this volatility can present significant investment risks, it also opens up opportunities for potential high returns. Imagine buying Bitcoin for a few dollars in its early days and then watching its value rise to nearly $60,000 per coin. That's the allure of cryptocurrency investing for many. But remember, the reverse is equally possible, and losses can be substantial. It's always essential to do your research and understand the risks before diving in. Now let's shift gears and talk about the legal status of cryptocurrencies. The regulatory environment for cryptocurrencies is as diverse as the digital currencies themselves. Around the globe, different countries have different stances. Some nations, like Switzerland and Malta, have embraced cryptocurrencies and blockchain technology, creating friendly regulations to foster innovation. On the other hand, some countries like China and India have imposed severe restrictions or outright bans, citing concerns over financial stability, investor protection, and potential misuse for illegal activities. Many nations fall somewhere in between, grappling with how to regulate this new technology while still reaping its benefits. In the United States, for example, cryptocurrencies are not considered legal tender, but are recognized as a form of property for tax purposes. Regulatory bodies like the Securities and Exchange Commission and the Commodity Futures Trading Commission have begun to provide guidance. But the landscape remains complex and fluid. It's important to note that as the technology continues to evolve, so too does the regulatory landscape. Governments and regulatory bodies worldwide are working to strike a balance between fostering innovation, protecting consumers, and maintaining financial stability. Despite the volatility and regulatory uncertainties, cryptocurrencies continue to attract interest worldwide. So why are cryptocurrencies so popular and how are they used? Cryptocurrencies are not just digital currencies. They represent a technological revolution, with uses extending far beyond simple transactions. The decentralized nature of cryptocurrencies allows for a variety of applications that challenge traditional financial systems. One of the most common uses of cryptocurrencies is for online purchases. With cryptocurrencies, you can buy goods and services from anywhere in the world without worrying about exchange rates or bank fees. This global accessibility is one of the reasons why cryptocurrencies are becoming increasingly popular. Cryptocurrencies are also widely used for investments. Just like stocks or gold, many people buy cryptocurrencies in the hope that their value will increase over time. However, due to their volatility, investing in cryptocurrencies can be risky, and it's essential to do your research before diving in. Remittances are another significant use case for cryptocurrencies. Sending money across borders can be costly and time-consuming with traditional banking systems. With cryptocurrencies, you can transfer value across the globe quickly and cheaply, making it an attractive option for migrant workers sending money back home. Now let's talk about some popular cryptocurrencies. Bitcoin, often described as digital gold, was the first cryptocurrency and remains the most widely recognized and used. It's primarily seen as a store of value and is often used as a hedge against inflation. Ethereum, on the other hand, is more than just a currency. It's a platform for creating decentralized applications and smart contracts, which are self-executing contracts with the terms of the agreement directly written into code. Ripple, or XRP, is designed for fast, low-cost international money transfers. It's often used by banks and other financial institutions for cross-border transactions. Lastly, Litecoin, created by a former Google engineer, is often considered the silver to Bitcoin's gold. It offers faster transaction confirmation times and a different hashing algorithm. Cryptocurrencies are more than just digital money. They are changing the world one block at a time,